Most people think early retirement fails when the market crashes. That's wrong. Early retirement fails when you are forced to sell at the wrong time for the wrong reason. If your plan only works when markets behave, you don't have a plan. You have a conditional agreement with the future, and the future doesn't sign contracts. Let me be very clear. A plan that requires everything to go reasonably well is not a resilient plan. It's a hope strategy, and hope is not a risk management tool. I'm not worried about a market crash in 2026. I don't need one. The most dangerous environment for early retirement looks like this. Nothing is cheap. Nothing is collapsing. Inflation feels manageable. Markets drift instead of crash. This environment can last for years, and during those years, something important happens. Decisions get locked in permanently, not dramatically, not emotionally, quietly. People don't panic. They don't change strategies. They just keep withdrawing. And every quiet withdrawal during the wrong period reshapes the future in ways that cannot be undone. Most retirement plans don't break from panic. They break from slow erosion. Let's make this ordinary. You retire early needing $30,000 per year. Inflation averages 3.5%. No crisis, no headlines, no emergency. After 10 years, you don't need $30,000 anymore. You need over $42,000 just to live the same life. You didn't overspend. You didn't fail. You were simply wrong about time. And time is not neutral in early retirement. Inflation is most dangerous when it doesn't feel dangerous. Now let's talk about the mistake that quietly destroys freedom. Sequence of returns. You retire with $700,000. You withdraw $28,000 per year. Your first 3 years look like this. Year 1 dropped 8%. Year 2 rose by 4%. Year 3 dropped 6%. No crash, no disaster. But you sold assets during down years to fund your life. Even if markets recover later, your capital base never fully does. You don't go broke. You just live smaller forever. The market always recovers. You might not. Forced selling is not an investing mistake. It's a structural mistake. You are forced to sell when living expenses continue. Income is gone. Markets are uncooperative at that point. Discipline doesn't help. Intelligence doesn't help. Experience doesn't help. Only options help. Freedom is not optimism. Freedom is optionality. If you're forced to sell, returns are irrelevant. Optionality is not a feeling. It's a structure, and it has 3 pillars. 1. Non-market cash runway, at least 3 years, of expenses that do not depend on markets. Spend $30,000 per year? That's $90,000 you do not touch stocks for. This is not about returns. It's about not selling when you don't want to. 2. Lifestyle flexibility. If your spending cannot bend by 20-30%, your portfolio will be forced to bend instead. Rigid lifestyles create fragile portfolios. 3. Psychological reversibility. Early retirement must be reversible, not an identity. The moment it becomes, I retired, options disappear. A rigid lifestyle creates fragile wealth. Ask yourself this: if my first 3 years are not great, not terrible, just average, does my plan still work? Without forcing me to sell. If yes, your plan is resilient. If no, you are not managing risk. You are managing hope. I've never tried to predict markets. I've spent my life avoiding situations where being wrong would ruin me. Early retirement magnifies timing risk more than almost any financial decision. Because you removed income, time is no longer your ally. Early retirement doesn't forgive bad timing, it multiplies it. Financial freedom is not reaching a number. It's the ability to live well when things don't go according to plan. If your plan only works when you're right, you are not free. You are lucky, and luck is not a strategy. The market is not your enemy. The 401k is not your enemy. Your real enemy is a plan that assumes cooperation from the future. Early retirement doesn't reward bravery. It rewards structure. If this made you uncomfortable, good. That discomfort is clarity.